Imagine you're standing on like a massive concrete floor.
Okay.
One you've completely trusted for years, built on layer after layer of historical data.
Sure.
But now imagine looking down and realizing that floor might actually be made of glass.
Oof.
And there are billions of dollars in leveraged bets resting directly on top of it.
Yeah, that's not a great position to be in.
No, it's really not. And today we are testing exactly how close that glass is to shattering. We have a clear mission for this deep dive.
Let's get into it.
Because Bitcoin just printed a $58,000 low. We're down almost 5% on the day, and I mean more than 30% off the May peak.
It's been a brutal slide, right?
And right now, there's a prominent bearish analyst ringing the alarm, claiming this drop is like nothing but a warm-up.
Yeah, I've seen that roadmap.
It's terrifying, right?
Yeah.
He's outlining a drop into the low to mid-50s, then a fake out bounce to trap late buyers, and finally, an incredibly ugly market-wide crash.
Look, it is an incredibly bold call to make, especially in a market that is, historically programmed to just buy the dip.
Exactly.
But instead of just reacting to the panic or just dismissing it entirely, we need to rigorously stress test his claims.
Right, we can't just guess here.
No, we're taking his entire roadmap, every specific price level, every single downside target, and we're running it through our own desk's data.
We're talking order flow, the breadth scanners, all of it.
Exactly. Our proprietary indicator levels.
Yeah.
We need to see if the underlying math actually holds up or if this is, just more algorithmic noise designed to shake out retail traders.
Yeah, and just to set the tone immediately for you listening, this is a top-down educational breakdown of market structure. This is not financial advice.
Definitely not.
We are just mapping the territory so you can make your own informed decisions with a clear head.
That's the goal.
So, to validate a macro bearish roadmap like this, we can't just stare at a 1-minute chart of today's price action.
No, you'll go crazy doing that.
Right. We would zoom all the way out to the macro structure to find out where the actual physical walls of this market are.
Right.
And then work our way down to the immediate timing. So, let's start with the weekly chart. Where is this supposed glass floor?
Well, the weekly chart is where this analyst's entire thesis actually lives or dies. At this exact moment, Bitcoin is hovering just above a massive band of historical support.
And that's between $49,000 and $55,000, right?
Exactly. When you analyze long-term market structure, a multi-year zone like this acts as like a sort of gravitational center. Buyers have historically defended it with their lives.
And the true magnet sitting inside that specific zone is the 300-week moving average.
Yeah, that's the big one.
Because this analyst has been publicly calling for a drop to around 55,000.
Yeah.
And we pulled the exact number off the desk's proprietary chart, and his math is dead on.
Spot on.
That 300-week moving average is sitting precisely at 54,433. But let's pause and actually explain the mechanics here. Why should anyone care about a line drawn across 300 weeks of data?
Well, because a 300-week moving average represents nearly 6 full years of price history.
That's a long time.
It is. It's all smoothed out into a single trajectory. In practical terms, it is the ultimate baseline cost basis for long-term holders.
Okay, so they see it as cheap.
Exactly. When the current price falls back toward it, long-term investors typically view it as an objective generational discount, and that creates a massive gravitational pull for bids.
But there's a problem here.
A huge problem, because right above it, acting as this oppressive ceiling for any potential bounce, is the declining 200-week moving average.
So the price is currently trapped in a tightening squeeze between the two.
Yes, between a rock and a hard place.
Okay, that gives us the macro pressure cooker. But how did we actually get trapped down here in the first place?
For that, we have to zoom in.
Right, to the daily chart. Because the mechanics of this slide become super clear there. Back on May 6th, Bitcoin rallied straight up into the declining 200-day moving average and was violently rejected.
It was a brutal rejection.
Yeah, and that single rejection at a major technical wall kicked off the entire current slide. But there is an algorithmic timing element to this slide that I find, honestly, just fascinating.
The countdown.
Yes, the daily buy setup countdown is currently on bar 3.
Yeah, and we ran that exact same sequential count on our own internal data to verify it, and we can confirm it's currently on bar 3.
For those unfamiliar with sequential timing models, can you break that down?
Sure. So these algorithms track the momentum of a trend to predict exhaustion points. If this specific algorithmic count continues uninterrupted by a sudden spike,
Which it could.
right, but if it doesn't, it completes right around July 1st, early next week.
Wait, let me make sure I understand the implication there. Does that mean the trading algorithms that institutions use are essentially like looking at a calendar and waiting for July 1st to start buying?
I mean, in a way, yes.
Yeah.
Algorithmic trading means these statistical windows are heavily front-run.
Interesting.
The machines are programmed to know when a trend is statistically exhausted. So the completion of that countdown creates a high probability window for a temporary market low.
Just because the automated selling pressure switches off.
Exactly.
Which brings us down to the 4-hour chart. This is the microscopic view, and honestly, it's where I see a glimmer of hope.
You're looking at the divergence.
Yeah, we're seeing a classic divergence setup. Bitcoin's price just made a low-hitting 58,000 today compared to 61,300 back on June 4th.
Right.
But the momentum indicators did the exact opposite. Both the RSI and the MCD made higher lows.
So let's unpack those indicators quickly for everyone listening. The RSI, or Relative Strength Index, measures the speed of price changes. And the MACD measures the relationship between two moving averages, essentially acting as a gauge for trend momentum.
So what does it mean when they disagree with the price?
Well, when price drops to a new low, but the speed and momentum of that drop are actually decreasing, which creates a higher low on the indicator, that is a bullish divergence.
Right. I always picture bullish divergence like a runner sprinting down a hill.
Okay, I like that analogy.
Right. Their legs are starting to slow down even though their body weight is still carrying them downward. The price is technically still falling, but the underlying energy pushing it down is completely evaporating.
That's a great way to visualize it.
But look, I have to push back on the optimism here. Does a textbook divergence on a 4-hour chart actually guarantee that we get a bounce?
No, it absolutely does not.
Okay, I figured.
It only guarantees a temporary loss of downward momentum. The issue is that momentum can stall out, catch its breath, and then violently reaccelerate downward if new sellers step in.
So it's more of a pause.
Right. Divergence simply suggests the immediate aggressive selling pressure is exhausted for now, which sets the stage for a relief rally.
Yeah.
But before you or anyone listening gets overly comfortable with the idea of a bounce, we have to pull all the way back out to the monthly chart, because this is where the trapdoors are located.
The trapdoors, man, this is the terrifying part of the roadmap.
It gets ugly here.
It really does.
Yeah.
Right now, Bitcoin is testing the 50-month moving average at exactly 59,281.
Correct.
And this retest perfectly validates the massive topping tail wick we saw printed back in May. But if that 200-week ceiling holds strong and our glass floor gives out, the descent below is completely empty.
It's a void. Once structural support breaks in a highly financialized market, geometry and historical precedents dictate the targets.
So what's the first trapdoor?
The first trapdoor is $37,000.
37,000. Why that?
Because that represents a standard 70% bear market drawdown from the peak, which is, historically very typical for this asset cycle.
Okay, but if 37,000 fails to hold...
If that fails, the next geometric target is 25,000.
And I want to clarify something about that $25,000 target. It isn't just a random psychological number.
No, not at all.
That is the measured move of a massive head and shoulders topping pattern. Now, look, I used to think chart patterns like head and shoulders were basically like financial astrology.
A lot of people do.
Right. But there's a real mechanical reason they hit their targets, isn't there?
There absolutely is. It isn't voodoo. It's a visual representation of buyer exhaustion. The left shoulder, the head, and the right shoulder show buyers failing at progressively lower levels.
So they're getting weaker each time.
Exactly. A measured move simply takes the height of the pattern's head and projects it downward from the break of the neckline. But more importantly, algorithmic trading bots are explicitly programmed to short the break of that neckline.
Oh, wow. So they write it down.
Yeah, they write it down to that exact geometric projection. The pattern becomes a self-fulfilling prophecy because the machines execute the math.
That makes a lot of sense. But the darkest target on this entire roadmap isn't 25,000.
No, it goes deeper.
It's a falling channel drawn connecting the extreme lows of 2018 and 2020. If you project the angle of that channel forward to today, the bottom boundary hits exactly 13,900.
Yeah.
Which completely validates the bearish analysts' terrifying $12,000 to $15,000 macro call.
It does, yes.
Yeah.
So we have successfully mapped out the physical walls and the trapdoors of the macro price structure.
But a physical wall on a chart doesn't tell us how hard the market is going to slam into it.
Exactly. We need to look under the hood at the market's internal engine to see the sequence of events.
All right, let's talk about the wave roadmap then. How do we actually track the sequence of a crash of this magnitude?
The sequence is crucial here because markets rarely move in a straight line. Step 1 is the drop we are currently tracking, flushing down into that 300-week moving average.
Which is right around the $54,000 mark.
Right. Step 2 is the relief rally, the bounce we discussed from the 4-hour divergence. But this roadmap projects that rally will stall out, form a lower high around 70,000, and fail right underneath the 50 and 100-week averages.
So it's a fake out, a trap for anyone who thinks the bottom is safely in.
Exactly. It is a classic Wave 2 bull trap.
Yeah.
And that sets up Step 3, the gut punch.
Ouch.
Yeah. A devastating Wave C liquidation drops straight into the $20,000 range. The psychology behind a Wave C is what makes it so destructive.
Because it happens right after they get hopeful.
Yes, it occurs after the market has offered a glimmer of hope. It catches all the late buyers who leveraged up on the relief rally, and it forces them into cascading liquidations.
So what's the missing ingredient right now? I mean, if this current drop to 58 is just the warm-up, what data tells us a real bottom hasn't formed yet?
Well, the answer is volume.
Right. Because since the peak in May, the volume profile hasn't shown widespread panic. It has just been steady, methodical distribution. Big institutional players quietly offloading their bags into retail liquidity.
Exactly. What we don't have is a massive capitulation flush.
And that's required.
That is the mandatory ingredient for any structural long-term bottom. You need panic volume. You need a singular, terrifying event where every weak hand throws in the towel simultaneously.
So what does that look like on a chart?
Mechanically, you are looking for a volume spike on the chart that completely dwarfs the surrounding weeks. Without that definitive panic volume, any bounce you see is mathematically likely to be a trap.
Which brings us to what I consider the most important rule of this entire deep dive.
Let's hear it.
If you only remember one thing from this analysis, make it the 50-50 sell signal.
Yeah, this is critical.
Here is how it works. If Bitcoin's price is below its 50-week moving average, and the weekly RSI is below 50, the asset is trapped in a 50-50 sell signal regime.
And it flipped officially bearish back in November.
Right. Today, the weekly RSI is sitting all the way down at 33. Reclaiming that 50 line is the ultimate non-negotiable all clear.
You have to watch that line.
But why is this specific pairing of indicators so uniquely potent?
Because it pairs absolute price trend with relative momentum. The moving average tells you the objective trend is down, and the RSI being under 50 tells you that sellers are consistently overpowering buyers on a closing basis.
So they're in total control.
Completely. When both are aligned negatively, trying to buy and hold is statistically equivalent to stepping in front of a freight train.
Wow. And the market psychology reflects that perfectly, right? The crypto fear and greed index is currently sitting at 17 out of 100. That is extreme fear.
Yeah, it's bleak out there.
Back in May, during the last relief rally, that index actually diverged bearishly. Price was going up, but the index couldn't even manage to cross back over the 50 mark into positive territory.
Because the underlying psychology of the market was already broken, even while prices were temporarily rising. Right now, it is showing some early microscopic signs of bullish divergence, but you have to remember, extreme fear can linger.
As the saying goes, markets can remain irrational and terrified much longer than you can remain solvent.
Exactly right.
Speaking of solvency, we need to address the black swan in the room, the proxy.
Ah, yes.
I'm talking about Strategy, the corporate entity formerly known as MicroStrategy. They peaked in November 2024, up almost 200%, leading the entire market top.
That was a crazy run.
But since then, their stock has collapsed by 50%, all while Bitcoin itself essentially remained flat.
Right. And they act as a highly leveraged proxy for the crypto market. When a heavily financialized proxy rolls over that aggressively, while the underlying asset remains flat, it signals a massive unseen liquidity drain happening behind the scenes.
But I have to ask you, is this just an over-leveraged outlier? Like a single company that flew too close to the sun with bad debt management? Or is this a true systemic risk to the entire ecosystem?
Oh, it is a profound systemic tail risk.
Really?
Yes, if they are ever forced by creditors to liquidate their massive Bitcoin treasury to cover their leverage obligations, it triggers an FTX-style cascade.
Oh, man.
Mechanically, you'd have a massive price-insensitive seller dumping billions of dollars directly into an illiquid order book. They wouldn't be waiting for good prices, they would just be hitting market sell.
Which triggers everyone else's stop losses on the way down.
Exactly, creating a self-feeding loop of destruction.
All right, so the macro indicators are clearly screaming risk off.
Loud and clear.
But to understand the immediate next move for you listening today, we have to get microscopic. We need to look at exactly where retail and institutional money is currently trapped.
Let's look at the order book.
Yeah, when we look at the desk's depth map, which visualizes all the resting buy and sell orders sitting just outside current prices, there is a massive wall sitting directly underneath the market at 58,800.
And it is critical to understand that this isn't just a wall of passive buyers waiting to catch the knife. That specific price level contains a $156 million long liquidation pool.
Let's explain what that means mechanically. It's like pulling the emergency brake on a speeding train.
Pretty much.
When a forced liquidation hits, the exchange doesn't care about getting the trader a good price. It just blindly executes a market sell order to reclaim the borrowed funds. That instantly vaporizes all the buy orders sitting below it.
It clears the board.
Right, so if price snaps below 58,800, that entire $156 million pool triggers at once, creating a massive vacuum that flushes the price straight down into that $54,000 to $55,000 support zone we identified at the start.
We can actually validate that pressure with the order flow, specifically the KIO delta.
What's that showing?
The cumulative delta is currently sitting at negative 38,000. That tracks the difference between aggressive market buyers and aggressive market sellers, and it shows heavy net selling.
Wow.
But the far more concerning metric is open interest. Open interest has actively climbed from 90,000 up to 106,000, all while the price has been falling.
Can you break down why rising open interest on a falling price is so uniquely toxic for the market?
Well, every new derivative contract requires both a buyer and a seller. Open interest tracks the total number of active contracts. If it is exploding higher while the price is dropping fast, it means massive, fresh leverage is actively piling into aggressive short positions.
And what about the people buying?
Simultaneously, it means the traders who are stubbornly going long are getting hopelessly trapped underwater,
Yikes.
building up even more liquidation fuel for the downside.
Okay, so Bitcoin looks undeniably grim on the micro level too. But here's what I don't get.
Look out.
When I look at the rest of the market, our Brett scanner shows a glaring divergence. The altcoin board currently shows 102 strong names versus only 79 weak names.
Right, they're decoupled.
Altcoins are actually catching aggressive bids while Bitcoin is lagging behind. Why are these speculative small caps spiking if the whole market is rolling over? Shouldn't the riskiest assets crash first?
Logically, yes.
Yeah.
But structurally, no. What you are seeing is classic late-cycle bull trap behavior.
A trap.
Yeah, when the major, highly liquid asset is rolling over, but retail speculative money is still aggressively chasing volatile small-cap altcoins, it means the market psychology hasn't fully transitioned into fear yet.
So they still think there's a quick buck to be made.
Exactly. It provides a false sense of security right before the floor drops out.
Looking at the top movers on the board names like Beat, Sky A, and Lab, they are completely untradeable right now. Their charts are a mess of erratic volatility.
I wouldn't touch them.
Same. But the desk did isolate 5 clean setups for rotational trading. Let's take our time and run through these specific picks with the exact desk numbers.
Good. But before we list these, we have to state the golden rule of risk management in a bearish regime.
Oh, absolutely.
Never risk more than 1% of your total account equity on a single trade. Preservation of capital is your only priority when the macro trend is against you.
Exactly. So setup number 1, Aave. The entry requires a confirmed hold above $80. Your stop loss is at 74. The target is 98.
Right.
That gives you roughly a 3-to-1 reward to risk ratio. Why Aave?
It is highly liquid and showing profound relative strength against Bitcoin's weakness, making it a safer harbor for capital rotation.
Makes sense. Setup number 2, VVV. Entry is around $13.60. stop at 12.85, target is 17.50. That's a massive reward to risk ratio of greater than 5 to 1.
It's a great setup.
The notes say this is a textbook pullback setup. What makes it textbook?
Mechanically, the selling volume completely dried up on the descent, and the price landed perfectly on historical moving average support without breaking it. It offers a very tightly defined area to place a stop loss.
Setup number 3, WLFI. Entry right around 0.0575 cents. Stop at 0.0545. Target is 0.064. Good for a 2 to 1 ratio.
Right.
The desk calls this coiled and tight. What does that look like on the chart?
It looks like a compressed spring. Buyers and sellers are deadlocked in an incredibly tight range. Volatility contraction almost always leads to aggressive volatility expansion.
Yeah.
We are positioning for the expansion upward.
Love it. Setup number 4, XPL. This is a pure momentum play. Entry around 10 cents. Stop at 9 cents. Target is 12.3 cents. This is a tighter ratio, about 1.5 to 1.
Yeah, and because it is a momentum play in a weak market, the risk of a sudden reversal is high. You must size this position significantly smaller than the others.
Good caveat. And finally, setup number 5, Velvet. Very volatile. Entry around 49 cents, stop at 42, target 75 cents.
Great reward there.
Great reward, but again, due to the extreme price swings, keep the position size incredibly small so a stop out doesn't damage your portfolio.
Now, those setups are strictly for the capital you have intentionally allocated to active short-term rotation. But we have to synthesize everything we just discussed into a broader macro strategy.
Let's do it.
With the structural walls, the internal momentum indicators, and the microscopic order flow all aligned, it's time to consolidate the noise into a single, actionable, top-down playbook.
Let's lay it out. Step 1 of the playbook. With Bitcoin currently sitting around 58,000, the immediate path of least resistance is down. We are looking for that liquidation flush into the $54,000 to $55,000 bounce zone.
Crashing right into the arms of that 300-week moving average.
Right. And we are fully anticipating a violent temporary wick down to 49,000 to completely clear out any remaining early buyers.
Step 2. When that bounce off the moving average happens, you respect the price action, but you treat it as a trap.
Don't fall for it.
No. You look for a relief rally, pushing back up towards 70,000 to form a clear structural lower high. In this playbook, that rally is not the start of a bull market. It is a definitive selling opportunity to de-risk your portfolio.
And step 3 is the downside trapdoors awaiting below. If that 70,000 fake out plays out exactly as the algorithms predict, you are looking at structural failures cascading down to 37,000, then 25,000, and finally the dark abyss of $12,000 to $15,000.
And remember the invalidation rule. The single metric that completely nullifies this entire bearish playbook is the weekly RSI crossing back over the 50 line.
Right.
Until that specific momentum threshold is crossed, the structural reality dictates that you remain completely defensive.
That is the roadmap, fully stress-tested and laid out. The data is on the table so you can make your own call with a clear head.
That's what we can do.
But before we sign off, there is one final chilling structural reality we need to consider. A scenario that builds entirely on everything we just discussed, but looks at the human psychology behind it.
Yeah, this is the part that keeps me up at night. If that historical 300-week moving average fails, a level that has acted as absolute unbreakable bedrock for the entire history of this asset, what happens to the psychology of the massive institutional and ETF buyers?
I mean, they're going to panic.
Exactly. These are traditional finance players who entered this market recently under the assumption that Bitcoin had permanently matured out of its historical 70% drawdown.
They thought those days were over.
Right. We talked earlier about waiting for retail capitulation to signal a market bottom. But if the structural glass floor breaks, and institutional capitulation Wall Street dumping their bags in a panic could make that $12,000 channel a reality much faster than anyone thinks.
Definitely something to keep a very close eye on as this week's trading unfolds. Make sure you manage your risk, stay objective with the data, and we will see you at the next deep dive.